When explaining the hidden aspects of achieving financial freedom after age 45, we step into a completely different territory from ordinary motivational talks. This is a system where emotions are exiled, governed by mathematical logic, and where human weaknesses are systematically eliminated as problem-creating factors. When Jim Simons founded Renaissance Technologies at age 44, he didn't just start a business by laying the foundation for one of Wall Street's most successful hedge funds. He converted one of the universe's most powerful forces, the pattern recognition ability brought by time and experience, into an advantage, and showed that the wasted energy of a 25-year-old can never compete with the hardened experience of a 45-year-old. This isn't just about age, it's about the neural networks in your brain absorbing decades of market crashes, financial collapses, and harsh lessons from wrong decisions, and instead of panicking at every fluctuation, transforming into a machine that operates solely with mathematical logic, cleansed of human emotions. If you're currently 45 years old and haven't gotten anywhere financially yet, the problem isn't related to your potential. On the contrary, it's in the operating system you're using, because you still make decisions based on simple emotions like fear and greed, talk about money as something that needs to be earned, and try to turn investment into a success story, when in reality the game is completely elsewhere. The main obstacle to success in the financial world isn't your intellect, education, or capital. It's two primitive emotions called fear and greed, encoded in your DNA and evolved millions of years ago to make life comfortable in the savannah, but which consistently destroy you in modern financial markets. Fear forces you to sell low when you're at your weakest. Greed whispers, be a little stronger when you're at your highest. And when these two forces combine, they turn your investment into the myth of Sisyphus. You roll the stone uphill, but it rolls back down again and again. The reality is that at 45, you've already experienced enough difficulty, seen enough loss, and your brain has already created emotional scar tissue, which is the only real advantage that distinguishes you from a 25-year-old new investor who panics during the next crash. You can now say, this too shall pass, because you've seen it pass many times before. Now all you need to do is transform money from being a score to what it really is, a tool and number system. Because this simple conceptual change cleanses investment of psychological burden and transforms it into a scientific process where statistics rule, not emotions. What advantages does viewing money as simply a number system give you? It creates a situation where you understand that each dollar doesn't carry emotional weight, that each loss and gain are simply statistical outcomes of the system working, and that a few unsuccessful trades don't destroy your entire strategy, because you're no longer a gambler, you're the casino owner. The gambler believes in his luck for one big win, sits at the table thinking this time will be different, while the casino owner never sits at the table. He simply knows the numbers. For example, even though the house edge in roulette is only 2.7%, through millions of spins, this small mathematical advantage inevitably turns into success. The system you should create at 45 works the same way. You're not trying to get rich with a few big wins. On the contrary, you create a small but consistent statistical advantage and repeat this advantage hundreds, thousands of times, because here time starts working for you. Wealth isn't important. What's essential is building the right system. And this means that financial freedom isn't related to how many millions you have in the bank. It depends on your statistical advantage and your ability to apply this advantage with discipline. The person who wants to be rich works day and night to increase their income, while the systematic investor starts reducing expenses, begins automatically investing a certain percentage of income, and waits, because they understand well that compound interest effect and time are their only support. In this situation, I'm showing you cold, hard, and unwavering mathematical logic. If you're trying to make money in financial markets, first of all, you must rebuild yourself according to a precise plan and completely forget human influence from your decisions, because the human factor, namely fear, greed, hope, overconfidence, self-doubt, each of these is a system that consistently destroys you. Creating discipline with zero emotion means you write your investment rules in advance, engrave them in stone, and under no circumstances, never violate these requirements, even if the market rises very quickly, even if the whole world seems to be rolling into an abyss. You are a robotized system, and systems don't feel emotions. Jim Simons minimized human thought processes in his medallion fund and relied on algorithms, because he knew that even the most knowledgeable and intelligent people make wrong decisions when under stress, but a properly programmed computer will never feel fear. The system you create at 45 should be based on the same principle. Make your decisions at the beginning and then simply execute without any emotional intervention. For example, let's say you decide to invest 30% of your monthly salary in an S&P 500 index fund. Whether the market is high or low, whether there's war or peace, it makes no difference, because you're not trying to time the market, you're dollar cost averaging, and this is a mathematically proven advantage. Then you decide that even if your investment drops 20%, you won't sell. On the contrary, you'll buy more, because statistics prove that major recoveries occur after severe crashes, and buying cheap is an intelligent strategy for long-term investors. You absolutely record these rules, hang them on your wall, and then forget all the emotional voices in your brain and simply become a robot. This is your only way out. Now let's talk about more specific rules, because philosophy is beautiful, but philosophy that can't be applied is just literature. Real change happens with very specific actions. First rule, make your investment decisions when the market is closed, not during market hours, because when you see real-time price movements during open market hours, your brain constantly starts switching to emotional mode and you can't make logical decisions. This is a fact proven by neuroscience. Second rule, never check your investment value daily, because each check is a small wave of dopamine and cortisol in your brain, and these shocks accumulate and turn you into an emotional reaction machine. Check your portfolio at least once a month, no more. Third rule, you should be able to fit your investment plan into one sentence. And if you can't do this, it means you don't have a plan at all, just chaos. For example, I invest $1,000 in the S&P 500 and $500 in total bond market index every month and won't sell anything for the next 15 years. This is a strategy. Fourth rule, absolutely never use debt for investment, because leverage not only increases your gains, but also sharply increases emotional tension and turns you from a system with statistical advantage into an emotional gambler casino. Owners never borrow money from anyone to open a casino. Fifth rule, diversify, but don't overdo it. 5-7 different asset classes will suffice, because even if you buy 30 different stocks, it won't make you Warren Buffett. It only makes tracking difficult and brings decision-making to emotional confusion. Sixth rule, before each investment decision, absolutely ask yourself these 3 questions. Is this decision based on mathematical logic or emotion? Can I apply this strategy for the next 10 years without changing it? Will this decision keep me awake at night? If your answer to the last question is yes, this investment isn't for you, because losing sleep means emotional stress, and emotional stress leads to making bad decisions. Seventh rule, write your past mistakes in a journal, and every time you make a mistake, ask yourself, did my emotion make this decision or my system? If the answer is emotion, try to identify that emotional trigger and absolutely write a note to prevent that trigger in the future. Eighth rule, one of the first mistakes you'll make is comparing your investment success with others, because comparison is the strongest expression of greed and will take you very far from your disciplined system. If your neighbor earned 500% from cryptocurrency, that's completely luck for them. Your strategies are based on long-term statistical advantage, not short-term chance. Ninth rule, pay attention to reviewing your investment strategy every year, but don't try to change it. Simply check if you can still adhere to your rules. Changing strategy is a completely emotional decision. Staying loyal to the strategy is a display of discipline. 10th rule, absolutely remember that investment won't bring you immediate profit. It's a game of win, wait, win, and the hardest part is being patient, because nothing happens there and the brain doesn't like inactivity. But it's precisely in this inactivity, this boring waiting, that the compounding effect shows its power. Now let's turn to the most important point. The main advantage of being 45 years old depends not on capital, but on the ability to recognize patterns. You've already seen the 2000 dot-com bubble, the 2008 financial crisis, the 2020 pandemic crash, and you've seen the same pattern repeatedly. Panic, mass selling, then gradual recovery, then new peaks. Seeing this pattern once is coincidence, twice is already repetition, 3 times is statistically considered truth. When a 25-year-old investor faces the first major crash, they panic badly and sell. But when you face the 3rd or 4th financial crisis at 45, you simply clap your hands and say, another cheap buying opportunity. This is the power of emotional scar tissue. This is your advantage. You no longer have that blind optimism that I'll be a millionaire in 1 year. On the contrary, you have real optimism. I know that if I work consistently for the next 15 years, I'll reach financial freedom, and this is mathematically inevitable. It's precisely this real optimism, this calm confidence strengthened by emotional wounds, that makes you invincible, because you're no longer fighting against the market. You're now playing the market like a game, and you know all the moves of the game. Remember that Jim Simons was a mathematician, not a trader, and he approached the market like mathematical problems. He found patterns, tested them, created algorithms that generated statistical advantages, and then launched these algorithms by completely eliminating emotions. You can proceed in exactly the same way. The only difference here is that your algorithms aren't in computer code, but in the form of simple rules written on paper. Invest X dollars every month. Never sell. Don't panic. Only buy more when it's cheap. These simple rules, when repeated many times, turn into mathematical advantage, and mathematical advantage, applied for a sufficiently long time, will inevitably turn into success. This is information the casino owner keeps to himself, and now this is your information too. You can even call it a secret. Now let's go deeper and understand why financial markets are essentially this laboratory of human psychology, and why at 45 you can be not a test subject, but a researcher in this laboratory. Every day the market shows you numerous opportunities to make decisions, and each of these decisions tests your emotional DNA. your fear, your greed, your patience, your self-control. Many people can't succeed in this test because they can't understand that they're prisoners of their emotions and can't see what psychological process underlies each decision. When you're 45, you've already gotten to know yourself sufficiently, and you know in what situations you might feel fear, in what situations you're overconfident, and what triggers influence you toward irrational actions. This self-awareness, knowledge about metadata, is something young investors can never obtain because they still can't fully understand themselves. They haven't yet seen their mistakes in a repetitive and sequential manner. Financial markets actually consist of two games. The first game is the game of numbers, charts, company balance sheets, and learning this game is easier than others. Try reading many books, go to some courses and learn information, and you'll learn the basic rules. The second game is a game of fighting with your own brain, your own emotions, your own willpower, and winning this game takes your entire life, because here you're fighting against your evolutionary programming. The human brain has evolved not to achieve success in financial markets over the last 200 years, but to survive in the African savanna over the last 200,000 years, and these two environments require completely different rules. In the savanna, if you see a lion and don't run, I can say with complete accuracy that you'll lose your life, so fear saves you. In financial markets, the situation is like this. If you panic and sell when the market drops 20%, you're doomed to financial death for a long time. Fear destroys you. In the savanna, if you found a lot of fruit and didn't gather as much as possible, you could go hungry tomorrow. Greed saves you. In financial markets, if after a stock rises 300% you don't sell, saying a little more, and then the price crashes, greed destroys you. At 45, your main positive aspect is that you've already learned to recognize these primitive instincts and silence them, at least partially, and even this partial learning makes you incomparably stronger than your 25-year-old self. Let's now talk about exact numbers and why a simple, boring strategy is always superior to an attractive, exciting strategy. Let's say you're currently 45 years old and can invest $2,000 per month. You have two strategies. First strategy, put $2,000 every month into an S&P 500 index fund and don't touch it for 20 years. Second strategy, try to be smart, try to time the market, try to pick different stocks, and absolutely believe in your success. Statistics show that an investor applying the first strategy will have approximately $1.2 million after 20 years, calculated at an average 10% annual return. An investor applying the second strategy will most likely lag behind the market, because research shows that 90% of active investors lag behind passive index funds in the long term. The reason is they try to make emotional decisions and they pay additional commission costs. They make systematically wrong decisions while trying to time the market. The most ironic point is that the second strategy is much more difficult, much more stressful, much more time-consuming, and at the same time less profitable. You work more, experience more stress, and earn less money. This is the perfect description of the emotional investment approach. Now let's look at the miracle of compound interest and learn why starting at 45 isn't late. On the contrary, it's a perfect beginning. Many people think I'm 45, I wish I had started at 25, I would have had a 20-year advantage, it's too late now. This is a wrong way of thinking, and this way of thinking forces millions of people to never be able to take the first step. Compound interest progresses exponentially over time, and the biggest growth occurs in the final years. For example, you're 45 years old and invest $2,000 every month until age 65, meaning for 20 years, and you earn an average annual return of 10%. In the first 10 years, you accumulate approximately $400,000. In the second 10 years, $400,000 will rise to approximately $800,000. And with your additional investments, it will be $1.02, 15 million. Do you see? The growth happening in the second 10 years is greater than the first 10 years because now you're accumulating not just your own money, but also the earnings from your earnings. And if you continue until age 70, the last 5 years will bring you more than the first 10 years. This is the power of compound interest, and even if you start at 45, you still have 25 years to make this power work. The problem isn't in not starting, it's in preventing yourself from starting due to fear of starting late. Now let's talk about risk management and understand why the biggest risk is not taking risk. When people hear the word risk, they're afraid because they equate risk with loss. But what is real risk? Real risk is your purchasing power decreasing by 3-4% every year at the hands of inflation. Real risk is keeping your money in the bank and watching it slowly lose value. Real risk is retiring at 65 and realizing your money will last 10 years, but you'll live 30 years. Investment risk, however, is a risk that can be managed, calculated, and minimized. If you diversify, think long-term, and don't make emotional decisions, investment risk is actually very low. For example, the S&P 500 index has never given negative returns in any 20-year period over the last 100 years, meaning, if you look at any 20-year period, even including catastrophic events like the Great Depression or the 2008 crisis, you ultimately earned positive returns. This is a statistical fact, and this should be your greatest source of reassurance. Being 45 means you have a 20-year horizon, and this is a statistically almost guaranteed winning horizon. Let's now look at practical examples and analyze real scenarios. Let's say you're 45 years old, earn $3,000 per month, and can invest $1,000. First year, you put $1,000 into the S&P 500 index every month. At year's end, you've invested $12,000. And let's say the market rose 10%, your portfolio is approximately $12,600. Great, but not amazing. Second year, you add $1,000 every month again. You've already invested $24,000. And if the market rose 10% again, your portfolio is approximately $27,500. Third year, $36,000 invested, portfolio approximately $44,000. Fourth year, $48,000 invested, portfolio approximately $62,000. You see how the difference grows each year. In the fifth year, your portfolio is already around $82,000, and you've only invested $60,000, meaning there's $22,000 in gains. In the 10th year, you've invested $120,000, but your portfolio is approximately $200,000, $80,000 in gains. In the 20th year, you've invested $240,000, but your portfolio is approximately $760,000, $520,000 in gains. Do you see the power? You've earned more than your own money, and most of this gain came in the last 5-7 years. This is the reward of consistency, zero emotion, discipline, and time. And remember, these calculations are average scenarios. If you increase your salaries and slightly increase your investment amount each year, the result will be more impressive. Now let's talk about tax efficiency and why your investment approach should align with your tax strategy. At 45, you've already paid enough taxes and you know how taxes work. Tax-advantaged accounts, for example, IRA, 401k, etc., are your closest friends because they give you two big advantages. Tax reduction now, traditional accounts, or tax freedom later, Roth accounts. Let's say you're 45 years old and in a 30% tax bracket. If you put $1,000 in a regular account, you're first putting post-tax money, meaning you've actually put $700, you paid $300 in taxes. If you put it in a traditional IRA, all $1,000 is invested, and you benefit from a $300 tax reduction that year. 20 years later, this $1,000 becomes $6,700, $10% annual growth. In a regular account, $700 becomes $4,700. You see the difference. And this is just one investment. Multiply this by 20 years x 12 months, $1,000, and the difference becomes hundreds of thousands of dollars. At 45, thinking about your tax strategy is important because you still have 15-20 years to maximize these advantages and minimize your tax burden in retirement age. Now let's talk more deeply about emotional triggers and how to fight them. Every investor has certain emotional triggers, situations, or events that force them to make irrational decisions. For some people, the trigger is a feeling of panic when the market drops 10%. For some, the trigger is hearing about a colleague's big gains. For others, the trigger is seeing "crisis is coming" headlines on financial news channels. At 45, your job is to identify these triggers and build counter-reaction mechanisms against them. For example, if you know that when the market drops 15%, the voice inside you saying, "I should sell, it'll get worse," gets louder, then you should write yourself a rule in advance. If my portfolio drops 15%, I won't do anything. On the contrary, I'll invest an additional $5,000. This rule turns an emotional trigger into a rational reaction. Or if you know you get anxious when watching financial news, then the rule is, "I won't watch financial news, I'll only do quarterly portfolio checks." Create a procedural rule for each emotional weakness, and these rules will become armor protecting you from your own truth. Now let's talk about diversification, but more precisely and tactically. Diversification means not putting all eggs in one basket. Everyone knows this. But at 45, knowing what diversification should look like is critical. Optimal diversification looks like this: 60-70% stocks, 20-30% bonds, 5-10% real estate and/or REITs, 0-5% alternative assets, gold, etc. Why do stocks make up the dominant share? Because you still have a 20-year horizon and stocks provide the highest returns in the long term. Bonds reduce volatility and give you emotional comfort. When the market crashes, your bonds usually either stay stable or rise a little, and this keeps you from panicking. Real estate provides protection against inflation and correlation is low, meaning when the market drops, real estate can move differently. Alternative assets play a small insurance role. But the most important point: once you set up diversification, you shouldn't break it. Rebalance every year, meaning if stocks have risen a lot and now make up 80%, sell some and move to bonds or direct new investments to bonds so the ratio returns to 70-30. This mechanical process forces you to automatically implement the principle of sell high, buy low, and this is completely free from emotional decisions. Let's now talk about crisis psychology and why crises are your biggest opportunities. History shows that great fortunes are created during crisis periods, not calm periods. In 2008, the market crashed 50% and people panicked and sold. From 2009 to 2020, the market rose 400%. If you didn't panic in 2008 and held, or better yet, bought more, you benefited from this 400% rise. In March 2020, the pandemic started and the market crashed 35%. A year later, the market reached its highest levels. The same pattern again. At 45, you've seen this pattern at least 2 or 3 times, and this is your biggest advantage. You already know that crises are temporary, recoveries are inevitable. Now your strategy is simple. When everyone sells during a crisis, you hold or buy more. This sounds easy, but in practice, all your brain signals will tell you you should sell. Everything is collapsing. This is exactly why you need pre-written rules. If the market drops 30%, I won't sell. On the contrary, I'll invest 50% of all my cash reserves. This rule should be written, expected, and automatically executed. During a crisis, your emotions are your enemy. Your system is your friend. Now let's talk about social pressure and the influence of the environment. At 45, around you are people in different financial situations. Some are already rich, some are still struggling, some continue spending and don't think at all. And this environment strongly influences your decisions. If all your friends are buying new cars, going on expensive vacations, and you're trying to invest, you might feel, why am I restricting myself? This is social pressure and it can destroy your financial strategy. At 45, you must decide, whose opinion do you consider important? The opinion of people who enjoy current status but have no financial future, or the opinion of your 65-year-old version? Your 65-year-old version will thank you for giving up entertainment at 45 and investing. Your current friends 20 years from now won't remember what car you drove. To stand against social pressure, create a support group for yourself, connect with people with similar financial goals, read books about financial independence, listen to podcasts, and immerse yourself in an environment where investment and savings are normal, even described behaviors. When you change your environment, you change yourself, because a person is the average of their environment. Now let's talk about the laziness paradox and why the do-nothing strategy is the hardest strategy. Although it's called passive investment, it actually requires the most active mental discipline. Every day the market changes, every day new news, every day new opportunities, and every day your brain tells you should do something. The passive strategy says do nothing, just hold. This goes against human nature because we're programmed to act, control, react. If you look at your portfolio and see one of your stocks has dropped 30%, your brain says sell, don't let it get worse. While the passive strategy says hold, statistics say recovery will happen. If another of your stocks has risen 200%, your brain says sell, realize the gain. While the passive strategy says hold, it can rise even more and you'll have to pay taxes. This is a constant mental struggle, and at 45 you must be strong enough to win this struggle, because you already have experience that taking action doesn't always produce better results. Sometimes the best action is taking no action, and this is the hardest lesson. Finally, let's talk about the true meaning of financial freedom and why it's not just about money. Financial freedom means you own your time. It means you're not forced to work at a job you don't love, you're not forced to communicate with people you don't like, and you're not forced to do things you don't want to do. Money is simply the means to achieve this freedom. The hidden advantage of getting rich at 45 is that you already know what work you love, what lifestyle you want, and what's important to you. You no longer live to impress others, you live for yourself. And this clarity makes your financial strategy more purposeful, more focused. You're not accumulating money just to accumulate, you're buying freedom. And this freedom creates the possibility to switch to part-time at 55, fully retire at 60, or simply know that if you leave your job tomorrow, you can live comfortably for 2 years and find a new job. This psychological security, this fuck you money concept completely changes your life, because the power of a person free from fear is infinite. Now, one last important point. Remember that this path isn't a lonely path and you need support on this path. Involve your family, your loved ones in this strategy. Explain to them why it's so important. Show them that this isn't sacrifice but investment in your future, your freedom, your family's well-being. If you have a spouse, set financial goals together, prepare a strategy together, and hold each other accountable. If you have children, teach them these principles: emotional discipline, systematic thinking, long-term focus. You're building not just your own financial future but a generation's financial intelligence. And most importantly, be compassionate with yourself. Sometimes you'll make mistakes, sometimes you'll make emotional decisions, sometimes you'll break the system. This is normal because you're human, not a robot. What matters is learning from mistakes, returning to the system, and continuing. Starting at 45 isn't late. What's late is never starting. Now go, build your system, make it unbreakable, and the future will belong to you, because mathematics, statistics, time, and emotional discipline are on your side. You're now the casino owner, and the casino always wins.